What if I told you that Mosman, Turramurra and Double Bay, some of the most prestigious postcodes in Australia, are some of the worst places to invest your money? Not my opinion, not a hot take. This is what happens when you actually look at the data. A brand new report has just dropped from Analytics. They've crunched the numbers on 4,440 suburbs across Australia, cross-referencing the ABS Socio-economic index called IRSAD against actual property price growth over 5 and 10 years. And the findings? They're brutal for anyone chasing the blue chip. We're talking 426 suburbs that have been flagged as no-go zones for long-term investors. 52 of those are outright in capital loss territory, negative growth over 5 years, and many of them in IRSAD decile 9 or 10. That's the wealthiest postcodes in the country. Meanwhile, the suburb most investors would never touch, IRSAD decile 4 to 7, the so-called middle suburbs. They've delivered 44.5% median 5-year growth. That's more than 5 times what the top decile managed. Today, I'm going to break all of this down. We'll look at why this happens, where the real money is being made, and why chasing prestige is literally costing people hundreds of thousands of dollars. I'm Sean from PropSpotter, and this might be the most important property video you watch this year. So let's start with the myth, the one your parents told you, the one every real estate agent repeats at the open homes, the one that's been gospel in Australia for decades. Buy in the best suburb you can afford. Blue chip always wins. Look, I get it. It sounds logical. Rich areas have good schools, nice streets, low crime. People want to live there, so the prices should keep going up, right? Wrong. Or at least that's what the data shows. The hashtag white paper uses something called IRSAD, the Index for Relative Socio-economic Advantage or Disadvantage. It's an ABS index that ranks every area in Australia from decile 1, most disadvantage, to decile 10, most advantage. It factors in income, education, employment, occupation, the whole picture. When you plot IRSAD against actual property growth, something wild happens. Across 4,187 high confidence suburb records, there's a negative correlation. I repeat, negative correlation between IRSAD score and 5-year growth. That means the wealthier the area, the worse the growth. And this isn't just because rich suburbs are expensive. They're controlled for price. Even after removing the price effect, IRSAD still independently predicts lower growth. The partial correlation is still negative. Let me put that in real numbers. For those in the mid-range IRSAD, 4 to 7, they had a 44.5% median 5-year growth. For the high suburbs, IRSAD 10, the most affluent suburbs in the country, they only had a 7.2% median 5-year growth. That's not a small gap. That's a canyon. Decile 10 suburbs averaged just 7.2% over 5 years. That's barely keeping up with inflation. Meanwhile, the middle suburbs were delivering 6 times the return. And it gets worse for blue chip. Out of 896 suburbs in decile 10, 34 recorded negative growth capital loss, supposedly in the safest suburbs in Australia. So why does this happen? Why do wealthy suburbs underperform? Hashtag calls it the crossover effect. And once you understand it, you'll never look at property the same again. Here's how it works. In premium suburbs, as prices climb, the buyer pool shrinks. Think about it. When a property hits $1.5, $2 million, $3 million, how many people can actually afford that? You're not talking about a broad market anymore. You're talking about a thin slice of high net worth individuals. Most of them, funnily enough, in Sydney and Melbourne. In a mid-range suburb, every price increase opens up new lending brackets. More people qualify, more competition, more demand. Prices get pushed up organically. But in a prestige suburb, there's no next tier of buyer above you. There's no one pushing prices higher. You're buying at the ceiling, not the floor. The data calls this out beautifully. Look at a 10-year compound annual growth rate by IRSAD price group and price group band. Below $1.5 million, low IRSAD suburbs beat everyone. They're delivering 7 to 8% compound annual growth rates. But here's the crossover. Above $1.5 million, high IRSAD deciles 6 to 8 usually takes the lead at 8.2% compound annual growth rate. That's because at premium price points, lifestyle, amenity, infrastructure, and school quality sustain demand from a wealthy buyer base. But here's the kicker. Decile 9 and 10, they still underperform. Even above $1.5 million, the very top decile delivers just 5.3% compound annual growth rate over 10 years at the $1.5 million plus price point. The most elite postcodes are a drag on returns no matter how you slice it. Let me give you some real examples from the hashtag no-go zones register. East Perth, IRSAD 10, negative 11% over the last 5 years. South Yarra, IRSAD 10, 0% growth, 5 years of holding costs for nothing. Newstead, Brisbane, IRSAD 10, negative 9%. And Darwin City, IRSAD 10, also negative 9%. These aren't dodgy suburbs. These are the prestige postcodes, and they're the ones bleeding money. Now, before you run off and buy the cheapest house in the dodgiest suburb you find, hold on, because the data flags a second trap on the other end of the spectrum. It's called the friction ceiling, and it's just as important. Low IRSAD suburbs, decile 1 to 3, deliver incredible growth, but only up to a point. The data shows growth peaks at a median price of around $650,000 to $750,000, delivering 12 to 13% compound annual growth rate over the last 5 years. That's incredible. But over $750,000, it falls off a cliff. Why? Because you've hit the borrowing ceiling of the local biodemographic. In a low socioeconomic area, there simply aren't enough buyers who can afford $800,000, $900,000, or even $1 million. The demand dries up. Infrastructure hasn't kept pace. School quality isn't attracting families from the next bracket. And there's a subset of suburbs that's even worse. The ones experiencing socio-economic decline. That's where the IRSAD score has actually dropped over time and growth has stalled below 5%. These are structural decline markets. People are leaving, not arriving. The no-go register flags 80 suburbs in this category. Places like Kambalda East in Western Australia, negative 25% over 5 years. Morawa, negative 21%. These are areas where the economic base is eroding. So the lesson here is nuance. You don't want the top, you don't want the bottom, you want the sweet spot. All right, so ladies and gentlemen, this is the bit you've been waiting for. Where should you actually be buying? The data is screaming it. IRSAD 4 to 7, median prices of $400,000 to $700,000. This is the Goldilocks zone. Not too hot, not too cold. These suburbs avoid the crossover effect that kills prestige suburb returns, and they sit below the friction ceiling that caps growth in a disadvantaged area. Let me hit you with the numbers. 5-year capital annual growth rates in low IRSAD, 12.3%. That's the peak growth rate in the entire data set. The probability of doubling in 10 years at $600,000 to $750,000 low IRSAD is 74.3%. Nearly 3/4 of these markets doubled. Compare that to decile 9 and 10 IRSAD at the same price, just 31%. And at $1.5 million plus, only 9.1% of low IRSAD markets doubled, but 65.5% of high IRSAD markets between 4 to 7 at that price did. So there is a role for higher socioeconomic suburbs, but only at the very top end and only in the 6 to 7 range, not the absolute elite. Here's what this means in practice. If you had $600,000 5 years ago and you bought in a mid-range IRSAD suburb, you could be sitting on a property worth $870,000 today. Same money in a deciles 10 suburb, you'd be looking at maybe $643,000. That's a $227,000 difference on the same purchase price. Stretch that to 10 years and the gap becomes hundreds of thousands of dollars more because of compounding. This is why at PropSpotter, when clients come to us saying, I want a blue chip suburb, we show them this data. We're not anti-blue chip for the sake of it. We're pro-returns. And the returns are in the middle of the socioeconomic spectrum, not at the top. If you want us to run this analysis on your specific target suburb, links in the description. We do a no obligation free call for any new clients. Now let's talk about the no-go zones register. Hashtag published a separate document alongside the white paper, which lists 426 suburbs across all states and territories. Let me give you the quick state-by-state breakdown. Western Australia leads the register with 177 suburbs flagged. That's nearly half the list. WA has the highest concentration of critical related suburbs. 30 of them are with negative growth. East Perth, West Perth, Fremantle, Northbridge, all IRSAD 9 or 10 in the red. New South Wales, second on the list with 79 suburbs. You may already know this. The big names are all there. Redfern, Zetland, Rhodes, Parramatta, Walleye Creek, high density inner city markets that have been hit by oversupply. Victoria, 74 suburbs. The blue chip suburbs dominate the list here. South Yarra, Toorak, Docklands, the CBD, Hawthorn, Armidale, all IRSAD 10, all delivering single digit or near zero 5-year growth. Northern Territory, surprisingly on the list with 42 suburbs. Almost the entire Darwin market is flagged. Durack, amongst many others, 16 are rated critical with negative growth. Queensland, 30 suburbs. Newstead and Bowen Hills are the worst performers in Brisbane. Regional Queensland also flagged for socio-economic decline. South Australia, 20 suburbs. Adelaide's eastern prestige suburbs, all on the list. ACT, 4 suburbs. Barton, City, Forest, Greenway, all with elevated risk. Last but not least, Tasmania. What about Tasmania? Well, Tasmania does not show up in the list at all. Tasmania is an all-go zone with no suburbs in the no-go zone. The register breaks each suburb into 3 risk categories: IRSAD crossover approach, friction ceiling approach, or socioeconomic decline. The worst suburbs hit 2 or 3 of these all at once. So let me bring this all together for you if you've been watching. The conventional wisdom of buy the best suburb you can afford is not supported by the data. In fact, it's actively working against those investors. The research shows 3 things very clearly. 1. The most affluent suburbs deliver the lowest growth. This is the crossover effect, and it's statistically significant across 4,187 markets. Number 2, the investment sweet spot is in the mid-range. So if you've got $1 million borrowing capacity, you're better off splitting it and buying 2 $400,000 to $700,000 investments in the IRSAD decile 4 to 7. These suburbs outperform premium markets by 5 times on a 5-year basis. And 3, there are 426 specific suburbs that have been identified risk no-go zones for long-term investors. 52 of those are in capital loss territory right now. And here's the thing that really gets me. This isn't a niche finding. This is a moderate to strong statistical correlation backed by tens of thousands of data points. The relationship between IRSAD and growth persists even after you control for price. It's real. Once again, this is exactly why PropSpotter exists. We use data like this, IRSAD scores, growth rate cycles, friction ceiling analysis to find suburbs that are going to outperform. Not based on vibes, not based on where your accountant bought their holiday house, based on evidence. So if you're a buyer, an investor, or a buyer's agent who wants access to this kind of analysis, check the link in the description. We offer a free initial suburb assessment so you can see exactly where your target areas sit on the IRSAD growth spectrum. Hit subscribe if you want more content like this. Drop a comment telling me, are any of your suburbs on the no-go list, or are there any suburbs you're considering? I'll check for you. Thanks for watching. I'm Sean from PropSpotter. Go find those mid-range gems.